welcome to Mercer Capital's webinar, Complex Capital Structures in Transfer Tax Planning, a Valuation Perspective. Lucas Paris and Sujan Rajbandari are today's presenters. They provide valuation and financial advisory services to business owners, families, management teams, attorneys, accountants, fiduciaries, and boards of directors. Their practices focus on complex valuation matters involving tax planning and compliance, financial reporting, corporate transactions, and strategic decision-making. As members of Mercer Capital's Gift, Estate, and Income Tax Group, Lucas and Sujan advise clients on valuations for gift and estate planning, income tax matters, wealth transfer strategies, and other tax-related issues involving privately held businesses and business interests. You can learn more about their backgrounds and experience in the Resources tab of this webinar. Before we dive in, let's review a few housekeeping details. If you encounter any technical difficulties during the webinar, please notify us using the chat box. To ask our presenters questions, please enter them into the Q&A box. We will address questions at the end of the webinar. To confirm your attendance for CLE credit, you must respond to all 6 of the poll questions that will pop up randomly during the webinar. Finally, don't forget to explore the Resources tab where we've provided additional helpful materials. Now, without further ado, I'll turn things over to Lucas and Sujan.
Hello and welcome. Today's session is focused on complex capital structures and transfer tax planning. Our learning objectives for today, first we're going to talk about common forms of complex capital structures and where you might see them in privately held business and in transactions of businesses. We're going to talk about different economic rights and how those rights affect fair market value of interests, whether it's tax planning, whether it is planning a transaction, or just being able to be conversant with your clients if these terms arise. We'll also learn to recognize the valuation methodologies that are used to allocate value among multiple ownership classes. We'll talk a little bit about the pros and cons of each of those methods, how they're used in practice, which ones might be best for different scenarios. And then finally, we will evaluate the implications of these different planning techniques that are associated with economically differentiated ownership interests. And we want to provide a disclaimer up front that we are valuation professionals. We are not attorneys. Nothing contained in this presentation or webinar is intended as legal advice and should not be construed as such. Treatments of interest within complex capital structures in the context of tax transfer planning requires a careful examination of legal considerations. So we encourage you to please seek competent legal assistance. So our summary for today's session, I've alluded to it a little, but why do complex capital structures exist? It is not merely to add length to a legal document or add billable hours to an assignment. These things have important value and economic purpose in the marketplace. Complex capital structures enable a separation of current value, downside protection, and future appreciation potential across different types of interests or to different stakeholders. And we're going to talk about why that is and how that works in practice. We're going to discuss how privately held business wealth has shifted over time from maybe more simplistic common equity structures towards more complex economically differentiated interests and what those look like and what are some of the terms of art that you may see in practice. For transfer tax purposes, we're going to see that interests arising from the same transaction might have very different values depending on their structure, their seniority, their liquidity, where they fit into the capital stack. And then we'll talk about how as ownership structures have become more differentiated, Valuation is increasingly central to both planning and reporting. Now I'll turn it over to my colleague to talk about evolution of capital structures.
Thanks, Lucas. Right. So where we are starting is with a stylized observation of how capital structures, even within our careers, even within our working lifetimes, have evolved. So what we had historically seen, and still do to some extent, obviously, is closely held businesses often had small, simple, common equity structures, a single class of equity that owned the whole company. And then when transactions of those companies occurred, those sales would be for cash, or in some instances, cash plus a seller note. And that was about as complicated as it got. Now, over time, in many spheres, private equity activity has increased. And now, whenever transactions occur, we're seeing things like rollover equity or preferred equity, earnouts, and profits, interest, and management incentives. Why did things change, from a single class of equity to a more complicated, complex capital structures? The complex capital structures do provide some flexibility. When we have non-pro rata division of ownership, a diverse set of stakeholders can take part in the ownership of the company. You might have buyers, obviously, being part of the ownership group. You might have founders who still want a little piece of the upside, even after selling the company, take part in the ownership of the company after the transaction. And then you might have people like management and employees who are providing sweat equity, but also want skin in the game in terms of the value of the company. So that flexibility allows for a diverse set of stakeholders to be owners of the company. And accordingly, the same flexibility can appear for M&A deals as well, where instead of having one chunk of proceeds go to one set of sellers, you can accommodate a bunch of stakeholders through the use of these complex capital structures. We talked about all of these different interests that we see in PE-backed transactions. They really represent innovation, right? So rollover equity, provides some leverage for transaction. Preferred equity, at the most basic level, provides downside protection for investors. Earnouts, they provide partial liquidity to the sellers and upside participation on the ongoing business. And then profits, interest, and management incentives align interests of management and owners and, give them skin in the game, as we talked before. Now, the implication of moving from a simple to a more complex capital structure is at the very beginning, let's say at the time of the transaction, the headline purchase price ceases to reflect, the complexity of the transaction. We're showing a transaction here, a stylized example again of an HVAC business, where on the left you have a traditional simple deal structure, on the right you have a more complex deal structure. I was talking with a friend and a client of mine just yesterday. He owns a small precision machining and tooling business, and he got an LOI for his business from another company that does similar work, but that one is owned by a private equity group. And it had all of the elements that we're talking about there, right? Upfront cash, rollover equity, earnouts that are contingent on future performance. And I asked him how he felt about the deal, and his first instinct was to say, "This is very intimidating." So, be that as it may, this is just a new new lay of the land.
Yeah, Sujan, I think what this speaks to is that there can be a trade-off between simple deals that might provide more certainty of close, and then perhaps more complex deals, which offer perhaps more upside exposure to the seller. But many times the sellers, they don't see these types of terms, or they don't see LOIs every day. And so it can be confusing, intimidating, to use your friend's word. And so it falls on us as valuation professionals, as attorneys, as accountants, as trusted advisors to help advise our clients into what do these terms mean economically in their situation. Because what we see is that a deal that is struck today, so a deal that, or may perhaps struck in the past, in the recent past, definitely has implications when it comes to transfer taxes tomorrow and future wealth and family planning. And why is this so important to advisors? Well, from a valuation angle, our goal is usually fair market value of a subject interest. That interest might be a common share, it might be a slice of preferred stock, it might be an option. But as these structures become more complex, the characteristics of those instruments can create different valuation outcomes that aren't always intuitive. So the liquidity characteristics for one versus the downside protections of another can create a disparity between value of a preferred share and a common share. And sometimes those two may be more linked, but other times they could be very far apart. These also impact one of the most frequently asked questions in this space, which is how big is the discount? What kind of discount is reasonable and supportable in this situation? Some of these structures embed some of those considerations into the models themselves. And so it requires careful consideration to make sure that you're not double counting. And all of those elements can introduce reporting and audit risk for an instrument that perhaps is gifted, it's transferred, and could be subject to IRS scrutiny, depending on the size of the transaction or the complexity, or perhaps just some sort of fact-specific circumstance that raises a flag, and then the valuation needs to be well supported.
Right. So, we've talked about how these different interests in a complex capital structure can have differing economic characteristics, right? So let's dig into that a little bit. Let's use the traditional single class common equity as our starting point. It has a pro rata participation in enterprise value and relatively straightforward, ownership economics. If we use that as a benchmark and say that has, medium or moderate risk and return characteristics and, similar medium or moderate valuation complexity, owned by founders, closely held business owners, and so on and so forth. The first, we've already introduced some of these concepts earlier. The first, line of, or the first batch of interest in a complex capital structure might be senior interests, or those that are designated stability-oriented interests, right? We talked about at the time of the transaction, there's a cash consideration, and obviously cash is fixed value. It is realized by the selling shareholders, and it provides, liquidity to the sellers that can then be used for any number of purposes, right? Including diversification or estate equalization, and so on and so forth. Cash, relatively low risk, relatively low return, and relatively simple valuation complexity. The next step there might be something like seller notes, which again, is going to be realized by or received by the selling shareholders. Now, this has slightly different characteristics than cash because the holder is now saddled with considering credit exposure, or repayment timing or interest rate sensitivity. Um, Again, relative risk and return fairly low, maybe a little bit more than cash. And the valuation complexity does increase a little bit. Um, but those two are probably, fairly common in all deals, even historically speaking. And then we get to something that is probably also present historically, but definitely a lot more present in the complex capital structures. These are preferred equity or preferred capital, senior economic positions with liquidation preferences, and or other preferred return characteristics. We'll dig into those a little bit more later. Typically held by uh, buyers, right? So private equity sponsors or institutional investors and so on, sometimes rollover holders. So these have stable economics relative to the company as a whole and may have different participation rights as deals can differ in how they're structured. So they are definitely sensitive to some of the structural terms here.
Touching on the kind of the next set of structures here with respect to residual growth equity, some of the more common structures are rollover equity, which we've mentioned. Rollover equity can be interesting because what that means is it is not equity in the legacy company, but it is often equity in the larger parent entity or the platform entity or the roll-up itself, which is now subject to risk, return, and growth characteristics of a different business. And that can create additional valuation challenges in planning. Management common equity is typically designed to reward participation of management, achievement of uh, financial metrics, financial hurdles, to align management and ownership. These things can contain transfer restrictions. They often also involve thresholds in which perhaps the original investors need to achieve a certain level of multiple of return on their invested capital before the instrument can begin to participate or gain value. So this is also another particularly challenging one relative to some of the other securities.
So we started looking at the risk return spectrum with the more stability oriented pieces. At the other end are um, ownership interests that are contingent on specific, value hurdles or some other hurdles that make them a lot more option-like. So a lot of things have to happen before these things start to accrue value, right? So again, coming from a transaction, the typical example is earnout or, sometimes called contingent consideration. The additional value assigned to those pieces are realized only when certain, operational or financial targets are met. These are held by selling shareholders and come with a bunch of risk, right? You have to hurdle the contingency. There might be some timing uncertainty as well. You have to think about credit exposure in terms of the counterparty that is writing you these terms. And then you always have to pay attention to the structure of the terms and the valuation assumptions that go into it. You see, as you can imagine, pieces like this, relatively high risk, relatively high return, and pretty complicated from a valuation standpoint. Then, from an operational standpoint, you might have things like profits interest and hurdle-based incentive equity that are owned by management, key employees or other operating partners. The idea is similar here again. Their participation in the total equity value requires the enterprise itself to hurdle some value or some rate of return and so on. Um, but they can have highly non-linear payoff characteristics, and they are getting the benefit of exposure to future appreciation of the company, but they are also very sensitive to the terms and assumptions, and those terms and assumptions can vary quite a bit. You'll also see things like catch-up provisions and, multiple hurdles uh, potentially here. So all of that just adds to the complexity when it comes to valuation, obviously high risk and high return. If you zoom out a little bit, in terms of the investors themselves, or maybe if you're thinking about the sponsors at this point, there are things like carried interest and promote structures. These are also, again, realized by specific parties. You might have sponsors here or operating partners. But the thing that they share in common with some of the other pieces that we've identified here are they have to hurdle, or the underlying equity enterprise value has to hurdle certain levels before these participation rights start to actually have some value in them.
So now we're going to look at some of these structural features in more detail. So we've mentioned things like a liquidation preference, but what does that actually mean? A liquidation preference relates to the kind of a senior claim on capital. Some of the key provisions that you might encounter in practice would relate to how that capital is returned. So it's a return of capital concept. There could be a stated interest rate or a return rate associated, 8% or a 12% preferred return. Sometimes these returns are cumulative and they can stack up over time. Sometimes they can accrue. Sometimes they increase at a penalty rate if they are not paid. The liquidation preference itself might require a multiple of return before the other classes begin to participate. And it is not uncommon to see 2x or even 3x liquidation preferences before a junior class can participate. Obviously, depending on structure of the deal, perhaps the bargaining power of the investors versus the owners and how that deal was struck at the point in time. And so the valuation implications of these structures is that they can shift current value more to the senior classes and make the junior classes more option-like. So the higher the preferences, the more multiples of preference that are required, further pushes down and squeezes on the junior classes.
So as Lucas mentioned, depending on the bargaining power, there might be more rights and features associated with the preferred class or the preferred interest, right? So there is a class of rights called participation rights. So these give the preferred holders the right to participate in the proceeds that remain after satisfying the liquidation preferences. So some of the deals have these, some of the deals don't, some of the capital structures do not have these. And even the ones that are participating, the terms might cap those participation at certain levels, right? So 2x their investment or 3x their investment or so on. Or they might be uncapped, which would be pretty punitive to the other share classes. Similarly, conversion rights are also fairly common for preferred equity interests. Some of these preferred equity interests might come with, optional conversion features, so at the option of the preferred holder. And there might also be automatic conversion features. Typically, we see these with regards to potential IPO exits, for example, where upon an IPO, all classes of shares mandatorily convert into a common class, so a single class after the IPO. The valuation implication of these participation and conversion rights are that, to the extent they exist, they can provide the preferred shareholders with both downside protection and upside participation.
So the other feature we'll look at here is incentive compensation. Key provisions around these types of features are threshold values for profit interest or management incentives. These are often described as a level of perhaps a dollar amount of enterprise or total equity value. Usually it is kind of set at a baseline. If there had been a recapitalization, that would become the new baseline when new profit interest awards are made, so that any appreciation or upside can go to the then current management team. Sometimes if these are structured not as profit interest, but as options or warrants, then you would have an exercise price. And so that's, again, is like a hurdle that the stock price or the value has to cross a certain level before the option or the warrant becomes in the money. And there might also be hurdles of return, whether it's percentages or multiples of invested capital that sometimes dictate when the interest can begin to accrue value. And so we see that these types of interests are at the kind of the far end of the spectrum in terms of kind of risk and return, and would really only drive value above those threshold levels. And we'll talk about how we would value those momentarily.
So before we get into valuation, just taking a little bit of time, there are a lot of words on this page, and we invite you to read them. We won't go through each of these. But we talked about some of the hard economic features and rights and conditions that are observed for complex capital structures. I think we would be remiss not to mention that there is an overlay of governance items as well, right? And these are not unique to complex capital structures, but to the extent that they do exist, and they vary from one deal to another, one company to another, you do have to pay attention to how these governance items like voting rights or board representations, distribution authority, and so on and so forth, interact with the other hard economic terms that are outlined for this particular company or for that particular complex capital structure.
So valuation of an interest in a complex capital structure is really a two-step process. The first step is determining the total enterprise or equity value. How large is the pie? This concept is probably more people are more familiar with this than maybe the next one. But this is, if we've got an operating business, what's the value of the business? If we've got a holding company or an asset holding company, an entity with perhaps real estate and mortgages, what's the equity value or the net asset value that is available to be allocated among the stakeholders? So that's step one, and we'll talk about some methods to get there. And then step two is allocation of that equity value across the capital structure to whatever classes of securities and interests are there. And we'll talk about those techniques. So looking briefly at step one, enterprise or total equity valuation, many of you may be familiar with the three valuation approaches, which are used in valuing businesses or asset holding entities: asset-based approach, an income approach, or a market approach. The asset-based approach is kind of literally what it sounds like. You tally up the market value of a company's assets, subtract the market value of the liabilities to arrive at a net asset value for the firm or the entity. This would be more common in entities that perhaps simply hold marketable securities, hard to value securities, real estate, and the like, or asset intensive businesses. An income approach, it would encompass, say, a traditional discounted cash flow analysis, or maybe a capitalization of earnings or net operating income to derive an indication of value today. And a market approach would look to the market for comparable multiples or valuation indications that we might glean from comparable public companies that operate in a similar industry. We're going to obviously look for size similarities, margin similarities, growth similarities when we can find it. Or we'll look to the M&A markets for where similar businesses have transacted and use those to correlate to a valuation that kind of really reconciles these three approaches. But for most businesses, one of these methods, one or two of these methods will be the primary way that you would value the enterprise or total equity before moving into a step two.
Right. So we've completed the step one, and as Lucas mentioned earlier, step two is to then allocate total enterprise or total equity value to the various pieces, right? So to visualize what is different for complex capital structures, let's look at a baseline where we have a traditional pro rata common ownership. We have a majority owner and a minority owner. The company has some current equity value. Time passes, and in the future, there are two states of the world. There's a downside and an upside. And in both of those situations, no matter what the total proceeds are, the majority owner and the minority owner are sharing those total proceeds, the total value of the company, if it is realized in the same proportion, right? So here we're saying 75% and 25%, three-fourths and a fourth. Whether we end up in an upside future state or a downside future state, these owners are sharing at the same proportion. Now, when we get to a complex structure, things change a little bit. We might still nominally say at the present, something like a senior preferred class owns 75% of the shares and junior preferred owns 25% of the shares. But in reality, what that means might differ quite radically depending on how the company itself does. Again, same downside scenario as in the traditional pro rata structure we considered, but here the value of the company, or let's say proceeds from the sale of the company, is not enough to cover the liquidation preferences that are owed to the senior preferred class. And in that case, the senior preferred gets to retain 100% of those liquidation preferences. On the flip side, on the upside scenario, we have the junior common getting to participate more than the nominal 25% ownership. So maybe 33% ownership or a third of the ownership versus two-thirds of the proceeds going to the senior preferred. So we can see that immediately the step two, right, which is the allocation to the various ownership interests in the complex capital structures, is going to depend on a couple of different things. One is we have to consider what the terms are of the waterfall of any given proceeds, right? Any given state of the world and the proceeds that are realized. What are the liquidation preferences? What are the participation and conversion rights and other hurdles that have to be cleared before, let's say, each successive ownership interest gets to participate in those proceeds? The feature of these, let's say, waterfall proceeds or the waterfall of the proceeds is that it can actually vary, and it does, depending on how complicated the structure is and what the ownership interests are. It does vary as the total equity value changes. So in addition to having usually a rules-based understanding of what the waterfall is, we also need to have some understanding or some design as to how the total equity values are expected to be distributed in the future, or what the spread of that total equity value may be in the future. There are a couple of things that go into it. Sometimes when an exit event is near and known, that might give us a very good idea of what the expected total equity value spread is going to be. Other times we might have to make some assumptions about what that distribution may look like.
So when it comes to selecting a valuation method to value the interests in a complex capital structure, there are a couple of different methods. And really, the selection of the method depends on answering some key questions about your situation. So if there is a near-term transaction event or a liquidity event, or the kind of the range of outcomes is somewhat known. So if we have a private company in a consolidating industry and many of its competitors have sold, there's probably an argument to be made that one of the most natural paths of liquidity is a sale of the company, perhaps as opposed to IPO or maybe some other situation. If it's an established business, maybe bankruptcy is off the table. But if those events can be fairly well defined, then perhaps a scenario-based method is appropriate. If the circumstances are a little more hazy, no near-term events can really be identified, the range of outcomes is more uncertain, then an option pricing method might be the way to go. And we'll talk about what that could look like. And then there can also be cases where either the waterfall or the payoff or the paths to liquidity are extremely complicated, or they are what we call path dependent. And path dependent is a fancy way of saying, for instance, if year 3 depends on year 2, which depends on year 1, then you have a path dependency in your model. And sometimes there can be need for catch-ups. Sometimes there are need to have look-backs or clawbacks or things like that. Those are difficult to model in traditional structures, and so we use what's called a Monte Carlo analysis to capture those types of structures. So the first one that we will look at is the scenario-based method. If you've been in this profession a while, you may have also heard this method called the probability weighted expected return method, PWORM, if you will. But really what it means is, what are the scenarios that can be framed out, and what valuations or outcomes would be associated with those scenarios? This is the most intuitive of the different methods. And so take, for example, what we see here. Say there are 4 likely scenarios for this particular company. Scenario 1 might be an IPO. Well, if a company is already at a size or scale, if they're operating as a quasi-public entity, they've got adequate systems, they've got professional management, professional accounting, that it could be a logical path to IPO, then that's something that should realistically be considered. If the company is likely to transact, then maybe we can model some upside sales and some downside sales. And those might differ depending on an upside that is involved, say, a strategic acquirer, might pay higher multiples versus a distress sale or a sale into a market in which conditions have deteriorated, or maybe there's the visibility is kind of weakened in that particular segment. So you can model different types of sales as other scenarios. And then finally, particularly for early stage companies, dissolution, bankruptcy, some type of forced liquidation is unfortunately a real possibility. And there are studies and surveys about success and failure of startup entities, and their kind of well-established ranges of how likely it is by stage of development that a company might move along that spectrum from perhaps a significant risk of failure to a more moderate risk to a going concern. And so for each of these, there is a question of, well, what is the waterfall outcome to the interest in each scenario? And then what is the probability of that scenario happening? So those are key assumptions that have to be thought about and supported to use this method. Now, some of the pros of this, as I mentioned, it's a fairly intuitive approach. Most people can wrap their arms around a scenario-based method. It's easier to talk about. It can capture uneven upsides and downsides, and it is good for describing kind of discrete outcomes. But obviously, one of the downsides is that it is highly assumption sensitive, which is perhaps maybe not a knock on the method itself, but it just means that the assumptions need to be well supported. They need to be tested. You've got to really support and substantiate these types of scenarios and the probabilities to the extent that you can. And sometimes all of that precision, this level of analysis can imply some false precision at the end of the day.
Right. So the next method that we talk about is the option pricing method. And this is really useful when we have situations where there is no near-term visibility into how the enterprise might do. Maybe there is no transaction on the horizon. And so you have to make some assumptions about how the value of the company is going to evolve. The option pricing method, as the name suggests, and as the graphic on the right shows, is dependent on or uses a very key insight that many of these equity interests, whether they be preferred or common and all the myriad interests that we talked about before, many of these in a wide swath of situations can be modeled as call options and sometimes digital options, sometimes some other flavor of options. If you think about the most basic case where even a single class ownership of equity, you could think of that as a call option on the overall enterprise value or the total invested capital of the business with a strike price equal to the principal amount of the debt, right? So that would be a basic call option that models an equity stake. Well, the idea is we can take that same framework of modeling equity interests as call options and then build it out to suit our needs given the complex capital structure that we're facing. This works, again, very similar. We are first mapping out what the waterfall might be by taking into consideration, what the liquidation preferences are and what all these other features and rights and preferences are across a set of equity values. The good thing about this model is this method is we are thinking about how that waterfall might change across pretty much the entire range of equity values, as opposed to the scenario-based method where we're looking at specific outcomes. And then the second step again is to say, what is the likely distribution of the equity values that we're going to model for option pricing methods? A lot of the times we're using, the law of normal distribution of share prices or stock prices that underlies, the most standard Black-Scholes framework. So we have a spread, a distribution of equity values. Those equity values are allocated to the various pieces in the complex capital structure. And then that really gives us the value of the preferred, the common, or the other classes that we're looking at. The good things about this model is that it can handle a lot of different ownership interests in one go. And it is very good in faithfully representing or faithfully capturing all the different rights and preferences that are associated with elements of the complex capital structures. I say all, but virtually all. Uh, the price we have to pay, the cons of using this method is it can be a little bit difficult to explain. And for many closely held businesses, some of the inputs that go into it, things like volatility or what the expected holding period is, and so forth, there is an element of subjectivity or really thinking that needs to go into it. Um, and much like any other model, this model is also sensitive to whatever inputs are provided to affect it.
And the final model that we're going to look at today is a Monte Carlo simulation. And the name Monte Carlo derives from the famous casino district in Monaco. And the reason for that is Monte Carlo is synonymous with random sampling to develop expected payoffs. So many samples, many runs to develop a distribution of the outcomes, and then an observation of what is the most likely or the average or the typical outcome or payoff that results in that distribution. These types of models are best suited for highly complex or path-dependent structures, as I mentioned before. And if you look at the slide, the approach of this step two, the A and the B, this is not a typo. One of the differences here in Monte Carlo is that at the beginning, we are defining both the forecast and the distribution of outcomes. So we kind of do it, we kind of turn the OPM or the option pricing model on its head a little. We still start with the total equity value, but then we define the parameters of our structure, which might include the drivers, whether that's an equity value, whether that's a revenue level or an EBITDA level, in the case of an earnout. The probability distribution would be defined usually per log normal distributions, kind of in alignment with Black-Scholes. We measure volatility for the interest or use proxies for volatility. Some of the variables might be correlated with one another. If revenue rises, it's often true that EBITDA will rise in a similar to a certain extent. So some of the variables may need correlation coefficients to further develop the framework. So there can be a lot of work that goes into developing this, and some might accuse it of being a black box, which is one of the cons, and it can be difficult to explain. But once that forecast and model is developed, then we often use simulation software to run the model using random sampling thousands of times or hundreds of thousands of times. And what emerges might be like something on the page of the outcome distribution. We can see that there are frequently a common path, common outcomes at the center of the distribution. And this one is somewhat normally distributed with higher values and extreme low values in the tails, and a central tendency around some outcome. We could discount those outcomes, average them, and develop an indication of value. So the pros of this type of model is that it can encompass a wide range of outcomes. You can easily handle path-dependent structures, and you can customize the model to your heart's intent. But as I mentioned, it can be accused of being a black box. So without proper explanation and understanding of how sensitive it is to certain assumptions, that can be a bridge too far for some. But for some structures, this is really the only way to go. And it does require a large number of iterations or outcomes to ensure that your answer is robust. So that means that you're typically going to use some advanced software to perform this type of valuation.
Right. So, we've talked about the various ownership interests in a complex capital structure with their various rights and preferences and so on, rights and features. We've talked about the valuation methods, but just to kind of give you a flavor of how option-like features, contingent features can result in valuation outcomes that are unintuitive. We're using a very basic setup, a fundamental setup, uh, where let's say there is a company out there with a total equity value of 50 million. The complex capital structure consists of two classes of equity, a senior preferred equity class and a junior common equity class. The senior preferred equity uh, gets 50 million in liquidation preference plus 11% in preferred returns, and the junior common equity gets to keep the residual. Now, we set it up as an example such that the liquidation preference itself here is equal to what we're calling the total equity value of the company. And so, a straightforward reading might be that the junior common equity has little to no value here. But really, we are thinking about what this company, how the value of this company might evolve in the future, and so on and so forth. So there is significant optionality embedded in these terms for the common class. So again, using, illustrative assumptions within a Black-Scholes framework, some holding period, let's say 5 years, some volatility assumption, let's say 35%. We're not assuming any interim distributions, and some risk-free rate, let's say at 4%. If we use these assumptions and the Black-Scholes valuation model, we're getting to the value of the junior common equity equal to $10 million or 20% of the total equity, even though it might not seem intuitive, even though it might not seem intuitive at the beginning. So just an illustration to show that these terms, these option-like terms, can embed some unintuitive results, some unintuitive valuation results, and this is really, the simplest example. A complex capital structure is going to have, many, many different layers of optionality spread across a variety of ownership interests. And as you can see, uh, the modeling, it's a good thing and a bad thing. Sometimes people are worried that the model itself is very sensitive to inputs, but it is a hallmark of a good model that it is sensitive to inputs. But depending on how you look at it, the option value that we've been talking about that accrues to the junior common class changes as some of the assumptions like holding period or volatility changes.
So a few of the things that we see in practice that are kind of problems in application of these types of methods. I won't read all of these, but I'll call out a few. I think anytime that you're relying on rules of thumb, whether it is for the enterprise value, if everybody thinks that these businesses are all worth 6 times EBITDA, and that's your starting point, all of the rest of the work you do is going to be flawed. So rules of thumb are dangerous both at the enterprise and equity level, but they can also be dangerous in terms of the complex capital structure in thinking about, oh, these are this is cheap stock, or these types of common shares are typically worth 1% of the preferred or 10% of the preferred. Well, that might have been true for one company in one instance in one structure, but it would be very dangerous to apply that to your situation. The other one I might call out is ignoring earnout probabilities. So frequently somebody might have an earnout that they received in part of a transaction, and we're talking about it may have a few years left on its structure. Um, it might be easy to argue that, oh, this has limited value, it is highly uncertain, it's got a lot of time left on it. Well, that's all option value. That's optionality. And so earnouts, particularly when it comes to transfer taxes and gifting and planning, should be evaluated based on the expected probability and timing and conditions rather than just their face value, whether that's the max, which you should not necessarily do, or assuming it's negligible just because it is too uncertain to model. So there are ways to model these types of structures.
Right. So let's tie it all back together to talk about complex capital structures within a transfer tax planning context, right? So we've already talked about, ownership interests like rollover equity or preferred classes and common classes and profits interests and carried interests and so on. Really, from a transfer tax planning perspective, we're thinking about these as elements that could be part of a gift planning or a transfer planning, or they might arise as just part of an estate administration, um, just ownership interests that are left over in an estate, or, again, the use case might be for charitable transfers of these complex interests. I think, from a planning perspective, we've talked about the various characteristics of the various ownership pieces. One could consider the downside protection and the future appreciation potential and so on and so forth to try to match who owns what piece and then accordingly plan out the gifting or the transfers and so on. The point we hope we've made in the presentation today is figuring out what the current fair market value of these interests uh, is not so simple. So we have to go to step two after even determining the value of the business as a whole to consider all of the different features and rights and provisions and make additional assumptions about how the company value might evolve before each of these pieces can really be valued reasonably. Um, the takeaway here, from our perspective anyway, is because some of these processes can take time, the analysis itself is complex, and the results might not be intuitive, at least not intuitive at first glance. It is, good practice to bring in valuation folks earlier rather than later, so that all of these issues, including, comfort level with where the valuation conclusions end up, there might be some element of understanding and education there as well, involving valuation professionals as early as you can is good practice, especially when it comes to these complex capital structures. And that marks the end of our presentation. I'm going to see if we receive any questions here. All right, here's one, Lucas, maybe for you. It says, we are accustomed to thinking about discounts for lack of marketability or DLOMs when it comes to simple capital structures. How does DLOM apply in the case of complex capital structures?
Now that's a good one. I guess I would say that discounts, they do still matter, but discounts for lack of marketability become more interest specific maybe than company specific. And so what I mean by that is we have to be careful not to double count illiquidity or timing considerations or uncertainties if certain of those factors have already been captured or modeled in one of our methods. So for instance, with an OPM, if we've already, say, defined the holding period as maybe a most likely 4-year period or 3-year or whatever it may be, we'd want to be careful that we don't also then make some assumption in considering the discount, which double counts something like that. Or perhaps the period was very long due to the uncertainty in the method. We wouldn't want to double count that in our discount approach. The other thing might be that when I say interest specific, a discount associated with a more senior class, a more preferred class, might be different than the common interest or a much more residual claim like a profit interest, just due to the differences in rights and governance between those two classes within the same company. So it is possible to have different levels of discount for different interests in the same business.
Well, speaking of the OPM method, here's another one, and I'm going to put this to you too, Lucas. Is the OPM applicable to private companies with no observable volatility assumption?
Yeah, you know, the OPM can still be used for private companies in that situation, and it's true. I mean, the best source of a volatility metric is if the company does have a traded stock, and you could actually calculate the price volatility in the stock. For public companies, we can totally do that. But for private companies, yeah, you don't have that observable metric. But often what we do have is a set of public company comparable firms that maybe we used those in developing the enterprise value as the step one. Well, we can look at that same set of public companies and look at their share price volatilities as a starting point. And perhaps we observe that. Maybe we recognize that there are significant size differences. Maybe there's significant scale, geographic, or concentration, diversification differences between our subject company and the publics. And then maybe there is an adjustment up or maybe down relative to the kind of benchmark that we observe for the public company equivalents. And so we could use that to develop the volatility that then feeds into the OPM. So it's the fact that it's a private company doesn't mean that we have to toss out the method, but we do have to sharpen our pencil on that assumption because it is one of the more sensitive assumptions in those types of models. Let's see, what else have we got? Sujan, here's one. I'll let you take this. How should we think about earnouts for transfer tax valuation purposes?
This one is interesting. I think back to the LOI this client that I mentioned earlier received. And as is pretty common, it was presented as if the earnout components that they were proposing he would receive would be full dollar amounts, right? And my valuation mind is immediately like, how do you feel about that? The point is, I think the value of the earnout arrangement is not going to be, the max amount or the face amount as it is presented in maybe an LOI or whatever discussion or however the buyer is presenting to you, right? We already talked about, how the value of the company, or in this case, how the value of the underlying metrics of the company might evolve over time. There is some distribution there, right? The earnouts are not going to be met, or the thresholds for the earnouts are not going to be met in all future states of the world. And, again, at a minimum, those earnout payments are deferred for some period of time. So evaluation of the earnout, at any given date, whether it is at the time of the transaction or after some time has passed, has got to take all of that into account. Again, we have to go through and use all the appropriate methods depending on the complexity of the situation and what we know about the company, ownership, and so on, to model it out. But I think, again, the main point is we just can't take a shortcut here and assume value equals the headline stated number.
Yeah, I think that's right. I mean, I was trying to think about just the prevalence of earnouts in
Yep.
transactions today, and I would say the more uncommon situation is when you see an LOI that doesn't have one. I mean, it's the way in markets where there can be different buyer and seller expectations, the earnout is the way to bridge the gap. And usually, if there's not one in there, the seller wants one. They want it as a sweetener on top of whatever structure is already in place. But then the buyer absolutely wants a piece of the consideration to reflect that if this business doesn't perform as they want it to, they'll have some protection, and that earnout will be zero if the business falters, and so they'll be protected there. And so you do see it as a bridge element, and particularly when there's a lot of uncertainty in the markets, like we've seen over maybe the last 12, 18 months. They are very prevalent across industries. Let's see. Um, Here's one. I'll let you take this one. If a preferred equity has a fixed return, why not just treat it like debt?
That's interesting, right? So most of the times, what we see is a preferred equity is not only getting a fixed return, right? So there might be other terms that we have to look at, examine, and then appropriately model. As we talked about earlier, they might have participation rights, and those participation rights might be capped or uncapped. There might be conversion features where these preferred equity pieces get to convert into something else, maybe common equity, given certain thresholds or maybe at the option of the preferred holders. So yes, while it is true that preferred equity usually come with a stated fixed return level attached to it, that's not the only thing that they have. They have, other moving pieces that you have to consider. One additional thing here is, it's in the name, right? Equity. So while it might be preferred and it might be more senior to other types of equity, usually if the business has some debt, outside debt or bank debt or whatnot, even though it is preferred equity, it might still be subordinate to that debt. So there might be some additional sort of modeling needed there as well. But interesting question. Let's see. Um, since you covered this part of the port presentation earlier, this one is for you, Lucas. And this may be the last question we have time for today. Early in the presentation, you mentioned the scenario-based method may provide a false sense of precision. What are some of the things you do as part of your analysis to guard against that possibility?
Okay. Yeah. So yes, I said the scenario-based method, one of the downsides is that it can provide this false sense of precision. Uh, Really, that stems from the method itself seems to be very intuitive, and it seems like, well, if we define these outcomes and we ascribe probabilities or ascribe levels or multiples or all of the inputs, we can do a really good job of pinning those down, and we will get an answer. The model will produce an answer. Now, whether that result is reasonable or not may be a different question. So this sense of false precision, you can have a highly precise model that is entirely inaccurate. So there could be a balancing of precision versus accuracy. And so to the question of kind of how do we guard against inaccurate answers? Well, one thing you can try to do, obviously, I think I said this, is firm up your assumptions, root them in supportable documentation as much as you can, tied to the market, tied to the company, tied to appropriate economic assumptions. But the other thing you can do is if there has been a prior transaction, say this was a company that had multiple investment rounds, and you have a price for perhaps the last investment round or the last class. Say there was a transaction that at the Series C, and our subject is the D round. Well, if we knew the price that was paid in and around the Series C raise, then when we do our OPM, it's going to value all of the interests in the capital stack, including the C and the D and any others. So we can compare our model's result for that other share class to the market observation that we have. And we call this calibration in practice. And so we can compare our result to a market-based indication. We can also do some back testing to say, okay, what would our model produce given these inputs, and then kind of how would it perform over time? What level of result does it generate? Compare that to some market evidence if there have been recent transactions. Another thing I hadn't thought of until just now is that more and more for privately held large companies, there could be secondary trading in the shares. And if there is a market for secondary interests, that should probably be at least known to the valuation professional, and you'd want to see how your conclusion compares to secondary trading activity. And there could be a lot of good reasons why your answer might be different or might be fact and circumstances specific and could depart from that, but you want to understand what any of those other market indications are. And so you're going to look at all of that to try to guard against having some outcome that just doesn't make sense or is not as robust as it could be.
Yeah, the only thing that I would add there to Lucas's point is, and this is something we've observed about this method for a long time, is it appears intuitive, but really a lot of skill and care has to go into it so that it is implemented in the right way.
Yeah, that's right. So I believe that is all the time we have today. We thank you for your attention, appreciate all the questions. If we did not get to your question, please reach out, please email us, call us. We'll be happy to talk with you about this presentation or anything else valuated related as it comes with respect to complex capital structures or transfer tax planning. Thank you.
Thank you.
Thank you so much for joining us today. If we were not able to address your question during our session, we will follow up with you individually. The recording of today's webinar will be available shortly, usually within the hour. You'll receive an email with a direct link, so keep an eye on your inbox. If you'd like to reach out with additional questions for Lucas or Sujan, please scan one of the QR codes on your screen to access their contact information or email them using the email address listed. CLE certificates will be emailed no later than Friday, July 17th. We appreciate your participation and hope you found today's discussion insightful and valuable. Keep an eye on your inbox for future webinars. Thanks again and have a wonderful rest of your day.